Hello, and welcome to Dragon Financial. Today, we'll discuss the basics of call options and how they work. First, we will review what we've already learned about options. Next, we will look at buying a call option. And finally, we'll go over selling a call option. Options can be difficult. So, if you have not seen the first video in this series, go ahead and click the basics of call option link here. The first thing we learned was that options are a type of derivative, which means that they derive their value from an underlying asset, such as a stock. We also learned that an option gives you control over 100 shares of a stock for a certain period of time. And finally, we learned that we can buy or sell options. This is Brad. Brad wants to buy his first call option. What does he need to know? In this series, we'll walk you through the basics step by step using a fictional stock called XYZ, priced at $100. With easy to understand examples, you'll learn the fundamental principles of call options. And later in the series, we'll delve into real life scenarios. So don't miss out on future episodes. Hit that like and subscribe button to stay updated on our next video. Brad has just learned about a new product the company XYZ will be releasing next month, and he thinks it'll be a hit. Brad believes the stock will go up considerably once this product is released. He wants to buy 100 shares of the company to cash in. Brad could buy 100 shares of the company at $100 a share for a total of $10,000. But Brad has also learned about a call option. He can buy a call option for 3 months at $5 a share for a total of $500. Brad decides to buy the call option, which will give him control over 100 shares of the company for the next 3 months. So let's review what Brad chose. He chose the stock XYZ, which is currently $100. XYZ is the stock symbol. It is also known as the underlying, and it is what the option contract gets its value from. Hence, derivative. If this doesn't make any sense, you probably need a review. So go ahead and click the link to review the basics of the stock market here. Brad thinks XYZ will go up a lot. So we can see that Brad is bullish on the stock. It costs $5 a share. So his total risk for the call option is $500. This is the max amount he can lose. Next, Brad calculates his break-even at expiration, which is the strike price plus what he paid, $5 per share. The price you pay is called the premium. So his break-even is $105. If XYZ is over $105, he will start making money. His profit potential is mathematically unlimited because the stock price can go up any amount. And for Brad, anything over $105 per share in the next 3 months is pure profit. Let's review a couple of options terms. Strike price, the price the call owner can buy the stock. Expiration, the date on which the call option expires. Premium, the price which the buyer pays to the seller. Max risk, the most money you can lose. Break even, the price at expiration that you will lose $0. Now we will take a look at the option payoff diagram at expiration. If the stock is less than $100 at expiration, you will be in the red zone with your max loss of $5 per share or $500, which sucks. But remember, if you had bought the stock, your max loss could be higher, even up to $10,000 if the company went bust. If the stock is between the strike price of $100 and the break even of $105, you'll be in the yellow zone and lose less than your max loss. Finally, if the stock is greater than $105 at expiration, you will be in the green zone and make money. Your profit potential is mathematically unlimited. Let's go back to Brad and look at the 3 scenarios. Scenario 1, the company had problems producing the product and never released it, so the share price drops to $80. Because this is less than the $100 strike price he bought, Brad lets his option expire for his max loss of $500, or what he paid. However, if Brad would have bought 100 shares, he would have lost $2,000. So by buying an option, Brad reduced his max loss from $2,000 to $500 in this scenario. Scenario 2. The company released the product on time, but it was only a mild success. So the stock price went from $100 to $103 per share. So Brad sells his option for $3 per share or $300. However, remember, Brad paid $5 per share or $500 for the option. So Brad will still lose $2 per share or $200. Scenario 3. Brad was right, and XYZ's product was a hit, and the stock price went up to $120 per share. So Brad sells his option for $20 a share or $2,000. Remember, Brad paid $5 per share or $500 for the option. So Brad's total profit is $1,500. Now we are going to look at selling a call option. Many things are similar, but there are some key differences. Let's go back to Brad. Brad made a lot of money on his 3-month call option as XYZ surged. But during the earnings call, Brad learned that demand for the product is tapering off, and they don't have a new product coming this quarter. Brad remembers all the excitement the new product caused and the stock going up to $120 per share. But without a new product, he doesn't think it'll go much higher. So Brad is neutral on the company, or maybe even a slightly bearish. Brad decides to sell a call option on XYZ stock at a $120 strike price for the next 3 months for $10 a share. So let's review what Brad chose. We have the same stock, XYZ, but now it is $120 per share. He is selling an option contract, so it will be 100 shares of the stock. His expiration for this contract will be in 3 months. His view on the stock is neutral to slightly bearish. Before we calculate our max risk and break even, we should review what selling a call option means. Remember, buying a call option gives you control over 100 shares of a stock at your strike price. Selling an option gives you an obligation or contract to sell the 100 shares to the buyer at the strike price. So when we calculate the max loss, it is mathematically unlimited because the stock XYZ can go up any amount, and Brad has to sell the shares to the buyer at $120. Unlimited loss? You have to be kidding me. Why would I ever do that? I know this sounds scary, but stick with this program and I can show you how to limit these losses, or even in some cases, eliminate them entirely. For example, the most common way to eliminate this unlimited loss is to own 100 shares in the first place. This is an option strategy known as a covered call, which completely covers you from this unlimited upside risk. We will learn more about strategies such as these as we continue the course. If you're excited to learn more about these strategies, hit that like and subscribe because I can't wait to teach you all about them. Now, let's calculate our break even. Brad was paid a $10 per share premium to sell the call option. Yes, you heard that right. He was paid money to enter the trade. How cool is that? So Brad has to sell the shares at $120 to the buyer, but he got paid a $10 premium per share. So his break even is $120 plus $10, which equals $130 per share. Okay, let's move over to the option payoff diagram. If the stock stays below $120 at expiration, Brad will be in the green zone and keep his max profit of $10 per share that he got paid up front. So if the stock goes down or even stays flat, Brad makes his max profit. If the stock is below his break even of $130 per share and above $120 per share, Brad will be in the yellow zone and he will make a small gain on the trade. This means even if the stock goes up a little, Brad makes some money. Finally, if the stock is greater than its break even of $130 per share, Brad's loss is mathematically unlimited, depending on how high the stock goes up. As you can see, if the stock goes down, stays the same, or even goes up a little bit, Brad makes money. However, if the stock goes up a lot, Brad can lose a mathematically unlimited amount of money. So this trade can be very risky. It is important to understand options before entering an unlimited risk trade. Let's go back to Brad and look at 3 scenarios with the stock. Scenario 1, the company had no new products released for the next 3 months, and demand for the new product slowly tapered off. As a result, the stock stayed neutral most of the time and slowly dropped down to $115 per share. Because the stock is under Brad's strike price of $120 per share at expiration, Brad will be in the green zone and keep his premium of $10 per share for his max profit. Scenario 2. The company announced a new product will be released next year, and the market started to get excited to learn more about it. So the stock price drifted up to $125 per share. Because the stock is above Brad's strike price of $120 per share, but still under his break even of $130 per share, it will be in the yellow zone. Brad will buy back his option for $5 per share or $500 to finish the trade. But remember, Brad was paid his premium at the beginning of the trade of $10 per share or $1,000. So Brad will make a small profit of $5 per share or $500 on this trade. Scenario 3. After a month or two of slumping sales, XYZ's product became a holiday hit and was the top seller for the season. This caused XYZ stock to soar to $150 per share, which put it in the red zone for Brad. He closed out the trade by paying the difference between his strike price and the current stock price, $150 per share minus his $120 per share strike price, for a total of $30 per share or $3,000 loss. But remember, Brad was paid a $10 per share or $1,000 premium when he sold the call, so his total loss will only be $2,000. Finally, let's wrap up by reviewing what we learned. When buying a call option, you will pay the premium and want to be bullish on the stock. You can only make money if the stock goes up a lot, and will lose money if it goes up a little and reach your max loss if it stays below your strike price. When you sell a call option, you'll get paid the premium, and you want to be neutral or bearish on the stock. You will make money if the stock goes down, stays neutral, or even if it goes up a little bit, but will have a mathematically unlimited loss if the stock price goes up a lot. There you have it, an introduction to buying and selling call options. I'm a teacher at heart, and I can't tell you how excited I am to introduce you to options. My name is Brad, and I have been investing in the stock market for over 10 years. I'm dedicated to sharing my knowledge and helping everyone become better stock traders. If you find this information useful, please like and subscribe so we can get it out to those who need it. If you are new to investing, check out my Basics of the Stock Market playlist here. Thanks for watching, and I'll see you in the following video as we go over put options.